Okay, this might be an unpopular opinion for my fellow infinite bankers and people out there, but I want to say this: an IUL or an indexed universal life may actually perform better than a whole life insurance, and I'm going to tell you why. But I'm telling you, stay till the end because I figured this out and what it really means for you. So make sure you're hanging to the end because there are some exceptions to this rule. So check it out here. All right, first, what's the difference between these, right? What's the difference between indexed universal life, whole life, term life, all this stuff? Now we know that term insurance is just death insurance. There's nothing to it other than you have to die for somebody else to get paid. It's cheap, it's easy, it's what people offer, it's what even insurance companies tell you to get. Why? Because they make more money off of you by term insurance. Even though it's cheaper, they make more profits because nobody dies, or hardly anybody dies. Less than 1% ever pay out. That's why term insurance is cheap. It's just death insurance. It's like auto insurance, right? You only use it when you have to use it. Now, there's two different other types of life insurance. There's universal life, and then there's whole life. Now, universal life has different options. Indexed universal life is the one that become more popular because, I remember back in the day when I was a financial advisor, I used to offer people variable universal life, which means you have a life insurance policy, but it also has this tax-free savings account inside of it, but that money could actually be invested in the stock market. Right? It was actually they don't call them mutual funds, they call them sub-accounts where you actually have money invested in mutual fund-like investments. So if the market went up, hey, you made lots of money. If it went down, you lost money. You might even have to keep paying more premiums just to keep it alive. So after Y2K, especially because that's when I became a financial advisor, was during that period of time and the market started tanking, VULs, variable universal life, became very unpopular because people realized, oh shoot, these things could actually implode. So a new option started to become more popular. I started doing it earlier before it got more popular today, which is indexed universal life, or IUL. IUL is simply where you can have money invested sort of aside with an index like the S&P 500, but you have a cap of how much you can make, but you also have a floor. It's kind of like working a job, right? You at least get a paycheck, but at the same time, you know that you got this glass ceiling you can never get through. That's pretty much what indexed universal life is. They'll have a floor, maybe it'll be 0%. So even if the market goes down, you might earn 0% or 1%. But if the market goes up, you might earn whatever it's returning until it hits about maybe 8, 9, 10%. Now, once it goes above that, if the market makes 20%, sorry, you give up the right to get that because you have a floor too, right? It's just like being an entrepreneur versus being someone who works a W-2 job. Sky's the limit if you're an entrepreneur, not so much if you work for a company. Well, that's what happens in the IUL. You've got those limits. That's great because if the market does go down, at least you're not gonna have, negative interest plus increasing insurance costs, right? Now, that's a good thing. But it may also not perform as well and it's hard to predict. And so I started selling IULs when I was a financial advisor. Now, when I was training on them, I was training other insurance agents how they worked. They started asking me, they said, hey, Chris, help me understand this. So what happens if this? What happens about this situation? What about this situation, this situation? And I started to realize there's a lot of situations where it could be a little bit riskier. So let me give you one, insurance costs. Now, insurance costs are different in these kind of different policies. For example, in an indexed universal life policy, insurance costs start out cheaper. It's basically term insurance that renews every year. So just like every year you get older, you're more likely to die. Sorry to break it to you, the longer we live, the more likely we are to die that year. So as time goes on, those insurance costs go up. So you see that happening in universal life. As time goes on, the insurance costs go up. It's really like buy term, invest the difference, if you really look at it that way. Now, as those costs go up, if you had a bad year, that's why variable universal life could be bad. If you have a bad year where you lose money and the costs go up, you could be in trouble. Well, indexed universal life has something similar to that too. Costs are going up and it's possible you might earn 0 or 1%. Yes, it is possible that even though you won't lose money from the stock market, you could lose cash value, that balance in your savings account, you could lose it if the market goes down. Not because, again, the market pays you negative or you lost money in the market, but because if you only earn 0%, but costs are still coming out for insurance, that value will drop, right? So that can happen. Now, insurance costs when it comes to whole life insurance. Now, whole life, we didn't talk about that much, but whole life is a little bit different. Whole life insurance actually starts out more expensive up front. It's the opposite, where universal life gets more expensive over time. Whole life starts out expensive and then gets cheaper over time. And the thing is, there's so many different ways to design a whole life policy, kind of like with a universal life policy too, but there's so many different ways to design it that most people, if you do it the traditional way that most people do whole life, most insurance agents, the problem is that you have no money in those first years. That's the biggest thing that people that love IULs will rip on whole life. They'll say, well, geez, look at those first few years. You have no money. At least we have money in ours. Yours is expensive. And there'll even be people out there say, oh, you get paid more money on whole life insurance. And then there's whole life people saying, well, I don't think so. Well, here's the truth. I'll tell you, I've done both. Guess what? You make the same money in either. In fact, I can make more money in IUL than I can in whole life, depending on how I design it, and vice versa. I can make more money in whole life than in IUL. Guess what? If you're an insurance agent and you just want to make money, you can find any way you can to manipulate the process. Heck, I make more money dollar for dollar from term insurance. So there you go. That's the thing, guys, is that, this whole debate about who makes more money doesn't really matter. The real question they should be asking is, who of their clients makes more money, right? Do you make more money as a client? Not them. We don't give a crap about them. They can do their own thing. We care about us. We care about ourselves, especially where I'm an investor first. And then, of course, yes, we do life insurance and things like that with our company, but I'm an investor first and foremost, and I have to look at this from the investment eyes. So those insurance costs on whole life go down over time where IUL goes up over time. Depending on how it's designed, sometimes a whole life can win, sometimes IUL can win. The other thing are dividends. I mentioned about how IULs can earn dividends. If the stock market does really well, like it did the last, really from 2009 and 2010, all the way through 2022, not including 2022, that was a down year, but through the end of 2021, we had actually 13 up years, 2009 to 2021. 13 up years in a row of calendar years. That was great for IULs. Heck, that was even great for VULs. They made way more money than whole life because the market was just straight up and it made a lot of money. Now, what could happen? Of course, now we're seeing the market go down. Well, what happens to whole life? Whole life isn't tied to the stock market. It just pays boring dividends, right? So whole life pays dividends based on the company's profit. If it's a mutual company, you want to make sure it is with a mutual life insurance company. You get paid from company profits. You get paid from their portfolio that's usually invested in things like bonds and treasuries, usually pretty boring stuff for that matter. And then of course, you also get paid because they guarantee a return of premium. And so, for example, they always budget in that they're going to return. And depending on what their guarantee is, the guarantee for the return is either 2, could be as high as 3, maybe 4%, depending on the whole life policy. So whole life has a very much higher minimum. It's not like 0 or 1. It could be 2, 3+%. But with dividends, they're usually paying right now, at least the ones that we use, between 5 and 6%. Now that's lower than what you can make on the IUL, because if the stock market takes off, guess what? Your IUL, let's just say that the IUL has a cap of 9%, you end up making 9%. Even if the market does double digits, you make 9%. That's gonna beat 5 to 6%, right? So you would think, okay, if the market's usually up, the IUL should win. And I'm here to tell you, it very well could. An IUL could actually beat whole life, especially if you time the market right. That's the problem though. How do we time the market right? The truth is we can't, right? And I can't predict whether you'll make more money in IUL or a whole life. But I will tell you this, is that I have the ability to do either for my own personal situation. I have zero IUL policies, but I've got several whole life policies. Why am I, as an investor, choosing whole life? There's a few reasons. One, I do like the fact that the costs go down over time, right? I do like that. That's a good thing. The thing that one of those guys mentioned, those agents, when they were asking me questions, they said, well, the costs are going up over time. Well, what happens if they go up and you don't make money in the market? Let's say the market goes down for 2 years in a row and I'm making that floor 0 or 1%. Couldn't I be losing money? I said, that's a good point. You could be losing money. But look, IULs are great. I was trying to convince them that IULs were awesome, right? Because again, I was trying to sell IULs while I poo-pooed all over whole life back in the early 2000s. I thought whole life was stupid. Not because I knew any better, but because that's what other financial advisors told me. So I just believed them. So I was saying, no, IULs are great. They're like, yeah, but what about this? Like, how about the surrender fees? Like, I can't even touch that money early on anyways. Well, it's a long-term vehicle. You save it for retirement. You don't touch that money anyway. So down the road, it could be good. Then they said, of course, like, well, what about this? What about the market, just doesn't perform great? Maybe it just goes up a little bit. Okay, well, then it goes up a little bit, but the costs keep going up, Chris. They do. What if I try to pull money out and the costs keep going up? Well, that can get pretty expensive. Well, you could run out of money. What if I got my guarantee? You could totally, the thing could implode. You could have to pay more money just to keep it alive. And all these things came up and it created more doubts in my mind. It doesn't mean that IUL can't win, right? But it does mean that the whole life, it's guaranteed not to lose money, right? It has a certain guarantee to it. That's why banks, just so you know, banks will offer lines of credit against IULs or whole life. But most banks don't want to touch the IULs. Why? Because of the very reasons I just mentioned. Costs keep going up over time. You can't predict what the stock market's going to do. And most time when people run illustrations for you, it's based on returns that don't work. Here's the other problem too. IULs, they can change the floor. They can make it go down to 0. Even if it's at 1 or 2% right now, they can make it at 0 and they can lower the ceiling. Did you know that when I was selling IULs before, one of the companies I worked with had a ceiling of 17%. The other companies I would write with were 12%. Now you'd be lucky to find anything over 9 or 10%. right? So they adjusted those things, which totally throws off your numbers. That means all the illustrations I did, the predictions of the numbers I did in the early 2000s were obsolete. Those numbers don't even work anymore because the numbers changed, forcing the numbers down. So you can't predict it. Where with whole life, often, I mean, not lately because the interest rates had gone down, but now they're starting to go back up. Now it's actually predicted we're under predicting what it's going to do in the future. So you can actually make more money with whole life. And if you design it the right way, especially where we do our max ROI infinite banking method with it, what happens is you actually get a lot more cash value that you can actually beat an IUL even with the market expectations that they may or may not get. You can still beat an IUL, have more cash from day one, use it to invest and get that double dip effect, which you cannot get with an IUL. You can actually use whole life to get your money to pay you in two places at the same time versus a wash loan with an IUL where you just get paid zero on that money that you borrowed. So when I do real estate investing and things like that, even other investors like myself, we look at it, we say, whole life's more guaranteed. We can do more with it. We can get double returns on our real estate investments and our business investments if you're a business owner. This is a no-brainer. And so that's why I go with whole life. Doesn't mean you should too, but I'm just here to tell you that I can't trust the IUL is going to be the thing that's going to make you a lot of money. I can't trust that's going to be there down the road either. And the truth is, I like something that's going to pay me now so I can make more money with my money now, because between all of them, if you want to use this as your retirement, it's not going to happen. I'm just here to tell you, no matter if it's a mutual fund or a life insurance product, neither of these things by themselves will get you financially free. It's impossible. It's just not going to happen. But you can become financially free if you have the ability to be able to invest your money in other things like alternative investments. And the best life insurance vehicle to help you do that is whole life insurance. That's the one that works best. It's the most flexible, allows you the most guarantees, so you're not worrying about whether you're going to make money in the market or not. It's going to make money regardless. And those dividends are getting better as interest rates go up too. So anyways, guys, I'd love to hear your thoughts. What do you think? Do you think IUL is better? Do you think whole life's better? I'd love to have you put some comments below. Let us know. And if you want to learn more about alternative investments, and especially about retirement and how you can actually live on $4,000 a month, check out this next video.